All right, we're live. Hey, John, how are you?
Hey man, doing good.
Good, good. Can you hear me well?
What's that?
Can you hear me?
Yeah, I can hear you.
Okay, sweet, sweet. All right, guys. Hey, happy Monday. Hope everybody had a good Thanksgiving, 4-day holiday for some of you guys. I honestly did not know what to do with myself for 4 days. I legit did not really work at all. So back at it on Monday. I have my kudos to you, kind of my friend, my mentor, who really I started in the business with, and John Shrine. He is actually a mortgage broker as well with Saguaro Lending, and thought about just having him on the show today and talk a little bit, not getting too much into the details because I know it gets super boring, but just what's going on in the housing market and just a couple of where rates are at, a couple cool programs that I don't think a lot of people know about. And we'll go from there. So how was Thanksgiving, John?
It wasn't bad. Really enjoyed the time with my my immediate family,
Oh, yeah.
my wife and my 3 kids, because we were all sick together. So
Oh, jeez.
weren't able to follow through with the plans that we had, but we made the best of it. Got through some projects, put up Christmas lights, all that good stuff.
That's good. Did Sarah and Joe, I forget, did they come down?
Well, they live here now.
Oh, they moved here? That's cool.
Yeah. They moved.
So you got the whole family here
in
now.
2021. Yeah, they
Yeah.
not too long ago. They live
Okay.
really close by, actually, within the same neighborhood.
That's cool. Oh, nice. There you go. Sweet. All right, let's jump into some technicals really quick here. I'll make this bigger. There we go. Kind of do this, but all right. So rates are at today, John. You have pretty much similar rates to me, but conventional 720 FICO with 5% down. So on a $600,000 purchase price, right now we're looking at about 6.318, and that's no discount points. Let me refresh this page so I could do some highlights here. I guess it won't let me. Oh well. So conventional 720 FICO, 5% down. We're at 6.318. APR of 6.819. So really no discount points or much origination in that. FHA 680 FICO, 3.5% down. We are at 6.075, and with an APR of 7.139. The only origination that's in there is going to be your upfront mortgage insurance premium. So no discount points, no origination on that. And FHA 680 FICO, 0% down. We are currently at 5.895 with an APR of 6.149. So again, no points, no origination to get there. That's going to be the big difference between working with a mortgage broker and a big retail bank, is that our rates are going to be much more competitive. You're not going to have to be spending a whole bunch of money getting into a much lower interest rate. So with that. John, what are you seeing as far as rates, or what's your outlook as far as rates? I mean, we have another Fed rate increase coming in December. The Fed rates don't really dictate the mortgage rates too much. It's more so inflation. And we saw that, 2 weeks ago when inflation, the CPI report came out for October, and we saw a big drop in interest rates, almost a full percent in interest rates. What are you thinking as far as going from here into 2023, where rates are going to be moving to?
If you'd asked me 3 to 6 months ago, I would have had, I don't want to say scripted, but a more articulate answer.
Yeah.
Whereas right now, I'm not 100% sure, to be honest with you. Like what that conversation looks like is certainly a camp of people out there that project that there's going to be an opportunity to refinance maybe 3, 6, 12 months out. Like the Federal Reserve, they've had some what we call tightening policy, as opposed to loosening. And by loosening, they lowered the federal funds rate. They purchase mortgage-backed securities. They do all these things to put downward pressure on mortgage rates. And so we're just having a close watch on Fed policy, right? The Federal Reserve and them doing things to affect the markets, I think has been such a stronger connection than maybe what it should be, but that's where we're at today. And so all eyes being on the Fed, it's their posture right now is still strong on tightening, being aggressive with raising rates, all these things that we that have caused rates to go up. But I'm hopeful that we're at a sort of leveling point here. But if you want to ask me my opinions, like today compared to tomorrow or this week compared to next week, I haven't been tracking it close enough. And so my answer, I guess, is a bit more general and broad in the sense that, yeah, I think somewhere between 6 and 12 months from now, we can see the Fed pivot in a way that's going to put downward pressure on rates. But
that means they need to get back into the mortgage back because they're 100% out of the mortgage. They've liquidated their balance sheet. Yeah, I believe so. They're not purchasing anymore. And I apologize. They're not purchasing any more mortgage-backed securities from what I understand. So their pivot would be to obviously lower the Fed rate, which is the short-term lending, but get inflation under control, but they get back into purchasing mortgage-backed securities because inflation and mortgage-backed securities are really the two biggest things, I believe, and I may be wrong, but, I believe those are the two biggest things that are going to help, press that rate down a little bit further. But this is kind of a raw rate that we're seeing. Obviously, inflation has caused a higher rate, but this is kind of the Feds aren't in there purchasing mortgage-backed security. This is kind of a raw, rate or mortgage rate. I mean, would you agree? Kind of what it should be.
Yeah, I see what you're saying. If there was no, if the Fed didn't involve themselves so much in ways that has such a direct impact on mortgage rates, what is the interest rate look like without the Federal Reserve's participation, injecting themselves into the matter? I think that's a fair way to say it. I like to, when it comes to thinking of it in those terms, I like to think of a handful of months prior to COVID-19. So let's just say second half of 2019, early 2020, we were looking at rates of around 4.75% or so. But I still think that was the Fed maybe being a bit more involved than really where they should. So I think that a true resting point, kind of the point you're making there, is somewhere between 4.75 and 5.75%.
Well, I have old files that we worked on. I mean, they're at 5.25. I mean, we had some 5% interest rates back in 2016, 2017. We have some 5% interest rates. 4.75. I think I saw a couple that I originated myself. So it's pretty much, I think that's, I wouldn't say it's normal, but that's the resting rate without the Fed injecting themselves, So,
well, your memory of that far back is better than mine right now. When it comes to the details of where the rates were at specifically,
Yeah, well, just seeing some LEs and stuff like that. So, but you never know. Who knows where we're gonna go? So, but that's good. Cool. Well, hey, I wanted to talk about one thing. You and we get super creative, or I learned from you being very creative as far as origination. And let me bring this up really quick. Can you see this okay?
Yep, I can.
So, a lot of the times people, I think they miss some great opportunities. When they're getting into purchasing a house, right? Maybe first time home buyer, doesn't really matter, right? But Home Possible, Home Ready, it's a conventional, affordable home program. And then we also have Freddie Mac Borrow Smart, right? I think those are two great programs. And a lot of times when people come to me like, hey, I don't have a lot of money down or a lot of money to put down, and there's immediately they want to go to FHA, right? FHA is a great program, really good program, but obviously it only requires 3.5% down. It has a little bit better interest rate, but there's some other mechanics that go into the FHA that may not be the best for that person, right? And so I wanted to talk a little bit about Home Possible and Home Ready and Freddie Mac's Borrow Smart compared to conventional, and how great those programs are compared to a regular conventional loan with 3% down, right? And as you can see, I priced it out this morning. Rates have kind of slightly gotten worse, but I priced it out this morning. The first one, it's a regular conventional, 3% down, 720 FICO score. at a $500,000 purchase. So that interest rate's at 6.753, APR 7.542. So there's really no, origination in there. But the interest rate is 6.7. That's pretty high compared to Home Possible, Home Ready. Freddie Mac Borrow Smart program is at 6.269. I mean, that's a big difference. It's almost a 0.5% as far as interest rates compared to the two.
It's a $215 difference in payment there.
Right. Yeah.
That's like a $15,000 car right there just on payment.
Yeah, exactly. And here's the other kicker too. If we look at mortgage, I do not know why this is not highlighting. Let me do this really quick. It's actually really bothering me. I don't think you can have two reports open at once. I think it throws a glitch in the system. So more importantly, if you go to these, the payment breakdowns, so we have conventional, Home Possible, Home Ready, and then Freddie Mac Borrow Smart. If we look at mortgage insurance, $242 for regular conventional with 3% down. If we go to Home Possible and Freddie Mac's Borrow Smart, we're at $181 right there. So that's $60 in savings, roughly, right? Just on mortgage insurance. And the nice thing is, and you can attest to this, John, Home Possible, Home Ready caps the mortgage insurance at a 25% factor, but it makes your mortgage insurance a lot less expensive, even with 3% down. Freddie Mac's Borrow Smart program caps its mortgage insurance the same as Home Possible, Home Ready, so it makes the mortgage insurance a heck of a lot more, or a lot less expensive, even with 3% down. Right.
Yeah, and you know what? Let me. I can say that's all technically correct, but another way to think about that is if you're putting 3% down, which by the way, anything less than 5% requires you to be a first-time home buyer.
Right. Exactly.
First-time home buyer, you can do less than 5%, a minimum of 3%. However, the mortgage insurance details that Nick's talking about is consistent with a 10% down payment. So there's mortgage insurance because there's less than 20%. But if you were putting 10% down, you're getting that price, that consideration on your mortgage insurance, yet you're only putting 3% down. So that is a significant difference, I would agree.
Yeah, actually. And the nice thing is Home Possible, Home Ready doesn't require you to be a first-time home buyer. There is, I'll get to the caveat.
Home Possible and Home Ready do not require first-time home buyer eligibility?
You just have to meet the income limits.
Oh, okay.
Freddie Mac's Borrow Smart is required. You have to be a first-time home buyer on there. But that's the savings right there. Interest rate and mortgage insurance, that's the big thing as far as these two programs. So, if you're looking to purchase a house, and I think a lot of times people, they always kind of steer people towards FHA because the interest rate is so much lower, right? This and that, or whatever have you. But I think, working with a really good loan officer, like John and I, we're going to bring other options up and have a deeper conversation as far as what is available to you. And the only reason why I would bring these up is that if I had a borrower who has a 720 or higher FICO score, these are great options for people as long as they can get underneath the income limit. And I'll go over the income limit in a second. But these are really good options for people that have higher FICO scores, and it might be a better option than FHA. FHA has the upfront mortgage insurance premium, and regardless of your credit score, it has a higher monthly mortgage insurance premium. Even if you put 10% down, the monthly mortgage insurance premium is much higher than, say, a higher FICO score on conventional. So with that. But the only catch to this is that it has an income limit, right? And so, well, it's all public information, so not like anybody can't find out where I live at. So I'll just do my house in Gilbert. So the income limit, it's not populating. Oh, they're not populating. the income limit on the Home Ready Home Possible is 71,000. Why is it not populating? All right. So with Home Ready Home Possible, they go off of the 80% area median income or AMI, and Home Possible, Home Ready, the income levels are the same. So they're at $71,040. It's zip code specific. Correct me if I'm wrong, John. It's zip code specific, but you always want to have your loan officer type in the exact address just to make sure, because literally you could be across the street and for some reason that just has a totally different area median income. But with the Home Ready Home Possible, the income limit is $71,040. So the qualifying income, whether it's one borrower or two borrowers, the total income cannot exceed $71,040 for qualifying. The nice thing with Freddie Mac's Borrow Smart program, you can either be at 80% or 100% area median income, and you actually get credits towards your closing costs. So I think it's $1,000 or $2,500 that you can get credits towards your closing costs. But that program also is income driven on there. So that's the caveat to it, is that they are income driven and you have to qualify as far as your income. But they're great programs for a lot of people. So with that, but yeah, those are pretty good. But I don't know. I mean, have you done a lot of those lately, John? Or have you had that conversation with people?
Yeah, Home Ready and Home Possible. That's a needle worth trying to thread pretty much every single time. Yeah, if you can make Home Possible or Home Ready work, then that's typically going to be the best option for minimum down options out there. Now, if you're a veteran and you qualify for a VA loan, like it's your primary residence and all that good stuff, that's probably going to be a better option. But if you're looking at FHA 3.5% down versus conventional Home Ready or Home Possible at 3% down, assuming your credit is, and that's another thing, your credit doesn't have to be very high to get good treatment on the Home Ready Home Possible. Yeah. So as long as credit's decent, then Home Ready Home Possible is probably going to be better than FHA at 3.5% down, which lastly to that point, always a good idea to have your credit pulled sooner than later, probably 3 months before you think you actually might need to use it, so that if we find a way to get your credit scores optimized, you have the opportunity to do that, so that your options are as good as they can be.
Yeah. How do you handle that a lot of people, and I think we all get this, you're talking to somebody and I think you brought it up, so I'll expand on a little bit, like, I don't want to get my credit pulled, I don't want to get dinged and this and that or whatever have you. And my like rebuttal to that, or just my comment to that, is like, okay, that's fine. But exactly like you said, John, is that your credit score is a big driver of your interest rate. The higher your credit score, the better your interest rate is going to be, right? Your credit profile or the makeup of it is a big factor when it comes to getting approval. If we can't get what's called our automated underwriting approval or AUS approval, there's really not much we can do, right? There is a manual underwrite, but that gets super expensive as far as the interest rates, how much you have to put down. You're
limited on banks that'll even do a manual underwrite.
Exactly. Yeah. So doing that work ahead of time, is always a really good thing. And I kind of compare it to like, hey, if your arm hurts, you go to the doctor and the doctor asks you what's wrong and you don't tell them anything because you just don't want to. How are they supposed to help you? You know what I mean? With that, and I don't know, how do you have that conversation, or what's your conversation with borrowers who just don't want to get their credit pulled?
Well, yeah. So like I think the number one reason why there's reluctancy to have your credit report pulled is you think the inquiry means a reduction in points, and not necessarily. It really depends. So I'll say it this way. If I were to pull your credit today and then pull your credit again tomorrow, I'm going to see the exact same scores.
Mhm.
And in my experience, if I were to pull your credit today, and once I were to pull it, I can use my what if simulator and Wayfinder and inquire of these tools.
Yeah.
If we do X, Y, and Z, what will the scores be 30, 45 days later?
Yeah.
Well, the results have been incredibly predictable. And just, I guess, a short way of wrapping up what I'm trying to say is based on my experience, I have no problem having my credit report pulled for a mortgage, even if I think I'm going to pull it again a week later, a month later, or 3 months later.
Yeah.
In my experience, in a scenario exclusively to what I just described. Now, if you start getting your credit pulled by multiple different inquiries like auto and credit card, and you start stacking and layering inquiries, a different type of credit, that's where
Yeah.
you're going to start seeing an adverse impact on your scores, consistent with what your impressions are. But if you're exclusively having your credit report pulled by a mortgage lender, it's 2 times in a couple months, 3 times in a month, or
Mhm.
2 months or 3 months or whatever.
Mhm.
I have had so much experience with doing that sort of thing that the results have been completely moot, if not easily inconsequential. And so, to really put it simply, worst case scenario, maybe you lose 1 to 3 points in your score, but the data, the intel that you're going to get in return is going to translate to increasing your scores by 10, 20, 30, 40, 50 points. So to give
Yeah.
you $3 to get $50 in return, I'll do that all day.
Yeah.
So just correlating that to points. To give you 3
Well,
points
and
for
I
50
think it's
points.
hard for
Yep.
it's hard for consumers to, it's like we do this every day, right? And if we ask somebody, what's your credit score, right? Some people might think that's a little personal. To us, it's an everyday question. What's your credit score? And somebody tells us a 695. I'm like, okay, we can do something with that. 695, that's not bad. I think it's just their perception, but it's, again, I always kind of, bash on big media, but it's big media and all those companies that kind of put that perception out there that, hey, don't get your credit pulled until the very last minute, right? But you and I know that that's what creates issues. That's what creates frustration. That's what creates bad experiences, because now it's like, we can't get you approved. You fell in love with the house. We can't get you approved because your credit score, your credit profile is just kind of a mess, and we need 3 months to work on it,
Yeah, and let me throw this in there, that what is the purpose of your credit?
Mm-hmm.
Well, it's to get loans and stuff like that. So, and then when it comes to different forms of credit out there, I would argue that a mortgage is the most important form. Like, if there was ever a time that I would engage credit pulling, improving activities, it's
Mm-hmm.
going to be for a mortgage, right? Like, if anything, I might be reluctant to have my credit pulled for a car loan, because maybe the rate that I get on my car loan is a half a point more, but for whatever, that's just a very dumbed down, simplified scenario. Let's just say, okay, if I got to do an auto loan and a mortgage loan, I'm going to give my mortgage loan preferential treatment any
Yeah.
which way I can. I'm not going to try to, I guess, stall or minimize the value I can get of having my credit pulled now, engaging all these different things,
Yeah.
where I'm going to, that's the thing that I'm going to make a priority. Yes, you can pull my credit for a mortgage. Like, that matters more than anything else out there. Let me wait on having my credit pulled for a car loan or something that's not going to be a $300,000-$400,000 loan.
Yeah.
Prioritize, engage absolutely 100% with the loan officer, with my mortgage, credit, optimize scores, etc., because that's where it matters far more than anything else, in my opinion.
Yeah, no, 100%. And here's a little note. If you are going to go purchase a car, this is just my experience, and actually my wife and I are going to go through it here shortly. Don't go to the auto dealer and have them, pull your credit. Because here's what's happening, John, you see this all the time. You go to a dealer, they get your credit information. What they do is they shotgun it out to 5, 6, 7 banks, right? That they
Sometimes
have
even like 10 or 20.
Yeah, exactly. And that's what's going to cause the big drop in your credit score because of the multiple inquiries. You're better off going to, I know it's Desert Federal. It's not Desert Schools anymore. It's Desert Federal something, blah, blah,
Desert
blah.
Financial.
Desert Financial. So you're better off going to a credit union. So we've had multiple auto loans through First Credit Union, and that's where I'm going to go. Right, I'm going to go to my credit union, try to get pre-qualified through them. They're, if you go there, they are the only ones that are going to pull your credit. So the likelihood of my credit score dropping because of multiple inquiries, it's very, very, very low, right? Because they're the only ones that are going to pull my credit and get us qualified for an auto loan. And that's, if you're going to get an auto loan, that's the best way to do it instead of going to a dealership, because they'll just shotgun it out, and you will see some significant drop in your credit score that way. So.
And it's my understanding that one of the reasons why they do that is because there is some margin that the dealer gets to make on the back end. Like, why send it to 10 or 20 because only one of 20 is going to approve it? No, it's where can we get the best deal, not necessarily specifically for the consumer. In fact, there's rules in place. So even though, like, I would say you could just know that guys like me and Nick are going to do everything we can to advocate for you getting the best rate, period. But there's rules in place that see to it that the consumer is getting the best rate as a result of us trying different lenders, not necessarily because of where we can get a delta on the margin. But with the car business, it's not housing, right? So auto loans, the auto industry doesn't have the same kind of protections and oversights as mortgage lending or anything housing for that matter. And so one of the reasons why they're shocking it out to so many differences because they're shopping for a margin that benefits them.
Right. So it's not consumer. Okay. I didn't know that. So even more of a reason why you should just go directly to your credit union or bank, get pre-qualified first, see what you can qualify for, and then go shopping for a car, and then you just let them know you already got your finances put into place. So,
or at least you can take that in and say, hey, you know what? I've already secured and lined up my own financing. Here's a really good deal. Now, if you can beat that, then I'll go with you. And then if they're making some money along the way, fine. But at least
you're still getting a good deal.
Some control of how that went, and and you got to choose it, right? And anyway, and you know what? When the time comes, give me or Nick a call when you get into that exact scenario.
Yeah, for sure. So, all right, cool, man. I think we're kind of coming up, and I actually got to run to another appointment, but I appreciate you jumping on the call. This is actually pretty fun. So I'll probably call you next Monday.
Thanks for inviting me.
Hopefully maybe we could talk a little bit more about, we've done a lot of it, but that credit optimization, looking at credit scores, we could talk a little bit more as far as, this is a tool that every loan officer has, but just because we all have the tool doesn't mean we know how to use it to the best.
You know what? There's some banks that recently cut their loan officers off from having access to it. It's not true. So I would say it this way, that only mortgage lenders have subscription rights to these tools. I don't know, unless something's changed. Last time I checked, these tools that we're talking about, only mortgage lenders can have access to it. And then the question is, does your company have you set up with access to it? And then do you even know how to use it? So a few things that have to be in place there to get the benefit of those tools.
For sure. And that could be $100 on your monthly mortgage payment because the interest rate could be so much
easily.
So that's good. All right, cool. Again, John with Saguaro Lending. John, I don't have a ticker up, but I know it's John at SaguaroLending.com, right?
Yes, sir. Yeah.
Okay. John at SaguaroLending.com. Obviously, my email down at the bottom, Nick at Valor Mortgage. Here's my phone number. John, what's your phone number really quick, just so people can reach out to you?
Oh, yeah. 480-442-4026.
So cool. I'll get a banner made for you next time. So
right on, man. Appreciate that.
There. So, all right, cool. Well, I appreciate it, John. I'll probably catch up with you a little bit later this week, and then maybe we can get another show going. Okay.
Cool, buddy. Sounds good.
Right. Thanks,
Have
John.
a good one.
Okay. Bye.
Bye.